Burns, how about you? Do you think we are tired here, and what constitutes success in getting out of this week?
Well, I would argue that the markets have probably gotten a little bit ahead of themselves this morning on word that there might be some sort of agreement with the trade talks tomorrow. I think that what's probably far more likely is a truce rather than a resolution. And I think as Ron Burgundy in Anchorman, who once said, agree to disagree. That's probably the best we could hope for, is that they agree to not put on more tariffs and not escalate further. But that's a long way from resolution. And so as the markets have moved upward this morning, they're probably getting a little bit out in front of their skis.
So the scenario of, all right, we're going to agree to disagree, as you said. We're going to turn around this narrative on trade. And then what? Then Q1, we start worrying about primary season and Elizabeth Warren?
I think in the near term, we're probably focusing more than anything on earnings. It's going to be a little bit of a disappointing earnings season. It looks like earnings should be down. They tend to get ratcheted upwards a little bit as you go through earnings season. But right now, with earnings expected to be down about 4% this quarter, even with the upgrades, they'll probably still end up down a little bit. I think that this may be a period where the markets do start to look a little bit at the fundamentals.
Jim, I don't know what you want to call a modified trade agreement, a slim deal, a smaller deal, a modified, whatever you want to call it. I mean, isn't for the market standpoint, one of the most important things to accomplish is no more tariffs? I mean, if we were to put a freeze on tariffs, wouldn't that really help the markets a lot in terms of what we can expect, how we model that into earnings, the outlook for capital spending?
All of those things absolutely would be the case. And it's not just a question of putting a freeze on tariffs, but hopefully winnowing down some of the existing tariffs and, of course, continuing to at least present the optical hope of some sort of trade talk negotiation that does even more than that. I mean, we sit in a moment in the market where the surface is very rough, whether it's recession on, recession off, trade talks on, trade talks off, impeachment inquiry on and on and on. This is a market where traders on the surface clearly getting sort of beaten up back and forth on a day-to-day basis. But for long-term investors, we go way below the surface where at least we can still be sort of calm, collected, cool-headed in terms of what we're looking at to add to the portfolio and also what we're looking to jettison.
Jim, in terms of how to think about potential returns, I mean, I think you can certainly say don't be all in, don't be all out. But there's this general sense out there that, we're kind of later days for this economic expansion, perhaps for this bull market. And therefore, even if things turn out okay for a while, that might be sort of a last hurrah type move. So where do you think we are in terms of the potential for this thing just being okay for a while? Or do you have to essentially lower expectations and say we've gotten most of what this cycle is going to give us?
I think you have to lower expectations. I don't know how close we are to the actual last hurrah, but it sure feels as if there's not a lot of chuckles left in this particular market, especially heading into the vitriolic 2020 election year. So we think asset allocation clearly is going to play a key role in terms of, even for growth investors, being able to buffer some of the expected increase in volatility over the next 18 months or so. And of course, for investors closer to retirement, now would be an excellent moment to review your portfolio and make sure that you're effectively close to investing your age in bonds and cash so that you can weather what I think will likely be a pretty tempestuous sea state for at least the foreseeable future.
Burns, you like industrials, technology, and healthcare. Does your view on healthcare change if Elizabeth Warren looks more likely to be the candidate?
Well, I think that one of the things that's interesting about healthcare today is it's trading. The healthcare equities are trading at a discount to the broader market for one of 3 times in the last 30 years, which is in many ways a way of saying that whereas I'm not really sure that the overall U.S. stock market is pricing in the prospect of a Warren presidency, but one sector is, and that's healthcare. It is pricing in that scenario. And at the same time, investors do have a lot of positives to look at there. You have stability of earnings. You have a lot of innovation. And certainly you have a lot of very attractive dividends there. And so, investors do have to be choosy. They do have to focus on stock selection there. But, and likewise, more than anything, because, this is the type of thing that the healthcare stocks are probably going to be in the bullseye for the next, well, at least until the next election, then it's something that really is for investors who have long-term time horizons.
Yeah, we've been asking for a couple weeks now, once her poll numbers started to jump, Jim, whether it was healthcare, financials, oil and gas, or big tech that faced the most policy risk. You got a thought on that?
I think it's healthcare front and center. It's certainly a long-standing overweight in our portfolios. We are watching the political landscape in the way that I never thought as an investor I would need to do as closely as we absolutely have to do. We certainly understand that socialized approaches to medicine would likely put a intermediate-term damper on healthcare stock prices. That said, the long-term necessary demographics, the emerging market growth story, the innovation, as Burns just said, all bode well for that sector for long-term investors. So we'll be buying on severe dips.